Good morning. You're watching All You Need to Know on Bloomberg Quint Live, and I'm Alex Matthew. First, the headlines. Crude oil prices have jumped the most since active futures were launched in 1988. That's after a drone strike on a Saudi oil facility wiped out 5% of global supply. The government plans a 20,000 crore special fund aimed at completing affordable housing projects. The centre will contribute 10,000 crore and will look to raise the rest from outside investors. The government also announces incentives for exports, provides 1,700 crore rupees to the Export Credit Guarantee Corporation. State Bank of India calls off its plans to list its general insurance business. India's largest lender had planned the IPO by FY21. And state-owned carrier Air India posts an operational loss of 4,600 crore rupees for FY19 due to higher oil prices and forex losses, but it aims to turn profitable this financial year. Let's begin with the big news from over the weekend. Crude oil prices have jumped the most on record after Houthi rebels in Yemen launched a drone attack on facilities of Saudi Aramco in the Abqaiq province. Brent crude futures have jumped as much as 19% as soon as trade began. They have cooled off since then. The most active contracts were launched in 1988, obviously, and this is the highest increase since then. The attacks have also put the proposed Aramco IPO in question. Riyad Hamad of Bloomberg News brings us more details.
So analysts we've been talking to are telling us that they think that almost half of the lost supply may be recovered as early as the end of play tomorrow. But in order to have the full lost supply back, it may, I think you mentioned it earlier in your comments, it may take several weeks before we have that.
Does that mean that Aramco actually has the storage capacity to meet demand in the meantime? What do we know about their supplies?
Yes, Aramco does have oil stored away, so it is going to be able to meet supply at least in the short term. However, if this does take longer, there might be a case where Aramco declares force majeure in saying that it's going to have to delay deliveries. But initially, at least, there is storage, there is oil available, so it's in the short term there isn't a danger of a shortage. Plus, also of course, we have heard from President Trump about his willingness to add oil supply to the market.
Well, the story around Aramco up until the weekend was talk of an IPO. How is this attack going to affect those plans?
That's a great question because, one of the issues of the IPO was to the pricing of Aramco. Will the IPO get the $2 trillion valuation that the Crown Prince was looking for? Most analysts were thinking 1.5 trillion at best. Now you have this uncertainty added to the mix. So it's certainly not going to make the job easier of the banks who are trying to convince investors to come in and invest in Aramco.
Saul Kavanagh of Credit Suisse believes that a prolonged disruption in the supply of crude can lead to demand disruption as well as demand destruction. Here's what he told Bloomberg Television in an interview a short while back.
If it's relatively short in duration, then Saudis themselves have said they're looking to continue sales from inventory. They've still got about a month's worth of inventory at the 5 million barrels a day output disruption at Abqaiq. So if it's a short disruption, then we're likely to see prices still rise as the geopolitical risk is factored more into pricing going forward, but only by a few dollars in our view. However, if this disruption proves to be prolonged, then we do have a different scenario, because if you look at where we could see response to make up for that shortfall, it's hard to find exactly where it's going to come from. Beyond storage, we've already seen Trump authorize access to the Strategic Petroleum Reserve in the US. We could potentially see a relaxing of sanctions on countries like Venezuela. But outside of the Saudi Arabia and Iran, there's less than 1 million barrels of spare capacity across all of OPEC. So you actually could see prices, in the instance that we have a prolonged disruption here, prices rise to the point where we start seeing actually demand destruction destruction. And that could therefore result in much more material rises in prices for a prolonged period.
At the demand side of things, because demand has been weak in this environment of slowing global growth, the trade war as well. So to what extent is this weak demand just going to keep a lid on things?
You've got to put it in perspective. So we've seen revisions down in demand over the last 3 to 6 months, but we're talking about hundreds of thousands of barrels a day in terms of scope. We've got here on a supply outage an order of magnitude larger than that in the form of 5 million barrels plus per day. So it's going to take significant revisions in demand before you can offset this supply disruption. It is still fundamentally supply disruptions of a geopolitical nature have a much more influential impact on oil prices, particularly over the near term, than demand side changes.
Now, Paul Allen of Bloomberg News is joining me now to tell you all about the trade in Asia. Paul, you were just speaking about the big talking point this morning, that is oil prices and the way they've moved. That's likely having a bearing on equity markets. We're expecting that to happen here in India as well. But how's Asia looking right now?
Yeah, it's not having perhaps the impact that you'd expect. Of course, we saw oil prices spike at the open. Brent now up 11%, West Texas up 10%, and President Trump since calmed things down a little, saying he'd tap the US Strategic Petroleum Reserve if needed. So here in Australia, for example, we've seen oil stocks among the big gainers, but the broader ASX right now is only off by a little shade under 1/5%. In South Korea, the Kospi is actually stronger by 1/4%, and New Zealand's kind of flat right now. We've got the Nikkei off for a holiday today. We've seen a bit of movement in currencies, though. The yen, its status as a haven, has seen that strengthen, and the oil-related currencies as well. The Canadian loonie, the Norwegian krone have also strengthened, and gold has been another mover off the back of that. That is up about 1%, currently hovering around the $1,510 an ounce level. We've just had China open in the past few minutes as well, and again, some reasonable gains we're seeing there, although we've got the Hong Kong Hang Seng Index off about 0.75%, but that's probably more due to internal issues there than any impact that we've seen from the oil supply story. Back to you.
Thanks so much for that, Paul. Let's talk now about Hong Kong and the protests happening there, which have now spilled over into the 15th week. Protesters have defied a ban on mass rallies gathering at business districts as well as the British consulate. Sophie Kamruddin reports from Ground Zero.
It's really quite surreal to see the Monday morning activity after what we saw on Sunday. I'm standing in front of the government headquarters in Admiralty, where the Legislative Council issued a red alert, which requires a complete evacuation of the buildings here as a group of protesters broke away from the main column of that largely peaceful rally to target this complex. They used petrol bombs, and riot police in return, they used tear gas as well as rubber bullets, pepper spray, and a water cannon to push the protesters back. And train stations were also affected in this district in Admiralty and elsewhere. They were vandalized. The Wan Chai MTR station, for example, had 2 entrances set on fire as more petrol bombs were used by protesters. So the MTR has said legal action may be taken, and the Hong Kong government has condemned the violence. Now, we are in month 4 of the unrest, yet there are no signs of protesters slowing down, even as the economy is being affected. On Sunday, the Hong Kong airport reported a 12% drop in passenger traffic for the month of August. That is the biggest decline since June 2009.
Let's look at what else is making headlines across the globe. Sue Keenan of Bloomberg News brings you the First Word headlines.
The latest from Korea. Reports from Korea say Kim Jong-un has invited President Trump to Pyongyang for what would be their 3rd meeting. The Yoonjang Ilbo says the offer came in a letter delivered last month and follows a separate note from Kim that the president made public earlier. Working level talks have stalled since this year's summit in Hanoi ended without a deal. It is not clear whether the president has replied to either letter. Meanwhile, the protests in Hong Kong have taken a more aggressive turn, with demonstrators setting fire to the MTR subway station in Wan Chai and police hitting back with tear gas, pepper spray, and water cannon. The unrest is into a 4th month, and the economy is increasingly under strain. Air traffic fell by more than 12% last month from a year ago. Passenger numbers down in China, Taiwan, and Southeast Asia. To the U.S. now, there's a new sign the economy is slowing. The Cass Freight Index is a monthly measure of rail, trucking, and air cargo volume, and it fell 3% in August from a year ago. That is the 9th straight month of decline. The index blames tariffs and the trade war for the downturn, which contradicts President Trump's claim that he's presiding over, quote, perhaps the greatest economy in U.S. history. And reports from London say UK Prime Minister Boris Johnson is ready to defy a new law against a no-deal Brexit and to fight his case in court. Sources inside the government say Johnson is taking an increasingly hard line as he prepares for talks with the EU Commission on Monday. President Jean-Claude Juncker is warning that a hard split next month will create utter chaos that will last for years. Global news 24 hours a day, on air and at TikTok, on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Sue Keenan. This is Bloomberg.
All right, let's talk about the Indian markets now. Agam Vakil is here to set you up for the day's trade and also tell you what's happening in the futures and options space. Agam, the big talking point here, of course, is going to be the impact that crude oil prices, if they sustainably stay high, will have on the Indian economy. And I think that pressure is going to be building in this morning as well.
Well, Alex, there's no doubt about that. We have to keep in mind the macroeconomic condition and the kind of impact the crude oil can bring, because that is very, very critical. However, we're going to have to wait and watch whether or not the market and how the market actually takes this forward. But for now, we do know that the SGX Nifty is down by as much as 1%, and we are likely to see a negative opening right at the start. There are a whole host of sectors out there which are impacted by crude oil, and we're just going to have to wait and watch as to how deep these losses can be, at least in early trade. That said, we did have a very good trading week for the indices, with the Nifty advancing by as much as 1%, mid-cap and small-cap indices also up and about. We saw gains coming in the banking indices to the tune of 1%. And of course, the PSU banking index a little bit subdued, but green all the same. And let's talk about how ADRs have panned out. So for now, at least, we're seeing some gains on the likes of Vedanta, ICICI Bank, and Wipro. And we're going to have to, see whether or not these sectors see an impact or no. But we are looking at some gains for now. That said, let's move on and talk about your fund flows. Again, we've seen the FIs move back into the sell territory, and the reason why we did see FIs buy into one-off stocks was largely on account of bulk deals. That said, DIs continue to buy, but again on a relatively smaller base. But you never know how things may pan out in today's day of trade. But we do see an up move around 1% as far as the Nifty is concerned. The key contributors there are private sector banks like ICICI Bank and Kotak Mahindra, Reliance Industries and Infosys also providing some amount of strength as far as indices go. But to talk about futures and options space, and again, we did see short covering coming through, decline in open interest for the Nifty futures, and the Bank Nifty futures also seeing an addition of nearly 3% in open interest. So we are actually seeing buying coming through out there. Can this reverse? Let's wait and watch. But in terms of options range, we're still looking at the 10,800 put as the one with significant maximum open interest, and of course on the higher end it's 11,200. We did see a lot of writing around the 11,200 call, so we'll be watching out for that as we move into trade. The wicks of course came off by as much as 5%, and the put call ratio as well, that rose by as much as to around 1.34. And in terms of stocks, we are keeping an eye on something like a Raymond, BPCL. Of course, the OMCs will be in focus in today's day of trade, Torrent Pharma and Container Corp. And in terms of unwinding, watching out for something like Engineers India, MRF and Reliance Capital. That said, Alex, it's going to be about how the opening comes through and what the Nifty can do from there on.
Thanks so much for that, Agam. All right, the finance minister over the weekend held a press conference and announced measures to boost the economy, particularly to boost exports and also to aid the flagging real estate sector. Let's start with the announcements meant for real estate. Here's a report by Ashwini Priyolkar.
Responding to demands from home buyers and real estate developers, Finance Minister Nirmala Sitharaman announced the creation of a special fund that will provide last-mile funding to stalled real estate projects. But not all stuck projects will qualify. To qualify, projects cannot currently be classified as non-performing assets and they should not be undergoing insolvency proceedings in the NCLT. They must also be net worth positive and should be 60% complete. And finally, the housing project will need to be in the affordable and middle income categories. The Finance Minister estimates that there are currently 3 to 3.5 lakh such housing units which could qualify for last mile funding. The government will contribute 10,000 crore rupees to the fund and expects to receive a similar amount from private players. Further, the fund will be professionally managed by experts from the housing and banking sectors and will be classified as a Category 2 alternative investment fund. Bloomberg Quint spoke to a few experts to find out what this would mean for the sector. KK Mistry, the Vice Chairman and CEO of HDFC, said the move would be positive as there are several projects that are more than 75% complete and are stalled because they need last mile funding. But he cautioned that there is a need to understand the definition of NPA that will be used for the special fund. If technical definition of NPA is used, then it will restrict the number of projects that will benefit. Mistry also indicated that HDFC would contribute to the fund. Abhay Upadhyay, president of the Forum for People's Collective Efforts, told Bloomberg Quint that the exclusion of NCLT and NPA projects is a wise decision as these have unique problems. Now, apart from the special fund, the government also relaxed external commercial borrowing guidelines meant for affordable housing projects, and the finance minister said interest rates on house building advances given to government employees will be lowered and linked to the 10-year GSEC yields. Real estate developers were not too happy with the announcement and said more was expected. National Chairman of Crude, Jakshay Shah, said that the government has just scratched the surface and it is yet to realize the gravity of the situation. Niranjan Hiranandani, the National President of NAREDCO, said that while the measures were a good start, they don't come close to resolving the problems relating to demand for residential real estate. We will now have to wait for the fine print to understand the implications of the government's announcements.
All right, but that headline announcement with regard to the special fund, let's listen to what HDFC's KK Mistry had to say with regard to those prospects and whether or not HDFC will contribute to the fund.
My sense is we'll have to wait for the guidelines to come to understand what is meant when the finance minister said non-NPA, because an NPA is a technical thing. If a developer has been unable to pay 3 monthly installments, the loan gets classified as a non-performing loan or an NPA. So if it gets classified as a non-performing loan, then based on what the finance minister said, the funds will not be available from this fund which has got created. Money will not be available from this fund which has got created. But we'll have to understand what definition is being prescribed to the word NPA by the, which I'm sure will get clarified in the rules. It cannot just be a technical NPA. I can understand, as you said, that if a case has gone to NCLT, then let the legal process take over. But just because 3 installments have not got paid because the developer has run short of money, if those kind of cases also will not be eligible for this kind of funding, then we'll be restricting the number of projects that could be that could get covered under the scheme. If as the fund is going to be professionally managed and professionally run, we would probably look at making some contribution. What amount and all is something we need to think through, but we'd be happy to make some contribution.
It's part of a larger conversation that KK Mistry had with Bloomberg Quint's Menaka Doshi. It's available on the website bloombergquint.com, so do have a look. Right now, let's also talk about the changes that were made to the export rules or pertaining to the export sector. Nikunj Ori has the details in this report.
Finance Minister Nirmala Seetharaman has announced a slew of measures to boost Indian exports. The Finance Minister has said that the government will provide a higher insurance cover to banks that provide working capital to exporters. This would be done at an additional cost of 1,700 crore rupees, and the government has also announced a new incentive scheme for exporters which will be called remission of duties or taxes on export products, and this will replace the current MEIS or merchandise exports from India scheme from January 1, 2020. The current MEIS scheme would continue till December 31st, 2019. Besides this, the government has also said that the RBI would review the priority sector lending norms for export credit, and this is expected to release about 36,000 crore rupees in export credit.
The Reserve Bank of India has notified draft guidelines for on-tap licenses for small finance banks. But the banking regulator doesn't want big industrial houses applying for the license, and a large chunk of the loans have to be issued to the priority sector. Vishwanath Nair has all the details.
Nearly 4 years since the Reserve Bank of India allowed 10 small finance banks to come into existence, the regulator has now put out draft guidelines for on-tap licensing of these entities. Now remember that these are draft guidelines only. After they receive feedback, the Reserve Bank of India will issue fresh guidelines which will be applicable for any applicant that might want to set up a small finance bank. Let's get a sense of who these applicants are and what kind of applicants the RBI is looking for. So basically, individuals and private companies that have some kind of experience in the banking and finance business, they can apply to set up a small finance bank. Small NBFCs, microfinance institutions, as well as local area banks, just like the last time around. However, public sector entities, large industrial houses, now according to the RBI's definition, those are companies with 5,000 crore worth of assets, as well as NBFCs which are floated by these large industrial houses. Joint ventures, now this was something that the RBI specifically pointed out, joint ventures between various promoter groups, as well as state finance corporations and DFI subsidiaries. None of these people will be allowed to submit a proposal to set up a small finance bank. Let's get a broader sense of what exactly the guidelines say, the draft guidelines say. They mention that a small finance bank will have to maintain a 15% capital adequacy ratio on a continuous basis. Now this is important because it is continuous and it's not something that is just maintained quarterly. Let's also get a sense of what the promoters should be holding in the company. As far as promoters are concerned, they need to have a minimum paid up voting equity share of 40% for the first 5 years. Now this 5-year period is a lock-in period, and the promoters will not be able to bring their share down below the 40% mark. But once those 5 years are over, then within the first 10 years of commencement of operations, the stake needs to come down to 30%, and within 15 years to 15%. And this is important as far as shareholding of the promoters in these entities goes. Also, these small finance banks will have to list as quickly as possible after they reach the 500 crore net worth mark. Now, the previous guidelines had put a 3-year timeline. Now remember that these are draft guidelines, so once the final guidelines come out, there might be a timeline specified by the regulator. We do not know that yet, but once those come out, then we'll discuss those further. As far as the businesses are concerned, the small finance banks will have to ensure that 75% of their overall book is towards the priority sector, as well as 50% of their total loan book has to be toward borrowers who borrow up to 25 lakhs. So that will ensure that only small borrowers get the benefit from the small finance banks and not some of the larger borrowers in the market. The small finance banks will also have to ensure that they do not have any exposures, any credit exposures towards promoters, any shareholders who have 10% or more equity in the bank, as well as relatives of these people as defined by law. They will also not be allowed to borrow from the small finance banks. So these are some of the key proposals that the Reserve Bank of India has floated as part of its draft guidelines. It has invited feedback till the 12th of October. Once those come in, then the Reserve Bank of India can start working on a final set of guidelines that will be applicable for any applicant that might be looking to set up a small finance bank.
Moving on, the government is going to guarantee payments on a bond issuance being made by a special purpose vehicle that has been set up for Air India. The aim is to raise 22,000 crore rupees, but it will be done in tranches. Advait Rao Palipu has more details.
Air India Assets Holding, a special purpose vehicle created by the Government of India in January last year to raise funds to repay Air India's debts, is going to issue a 7,000 crore bond on September 16th. Bankers close to the issue have told Bloomberg Quint that the bond will have a base issue of 1,000 crores with a greenshoe option of around 6,000 crores. The bond has been rated AAA by both India Ratings and ICRA. The SPV was created last year essentially to warehouse several non-core assets and 4 Air India subsidiaries. Of the 60,000 crores worth of debt of the national carrier, around 30,000 crores is under the SPV. Now, unlike other PSU bonds with a government guarantee, bankers told Bloomberg Quint that this bond is a Government of India fully serviced bond. What that means is the repayments on the principal and interest of the bond fall squarely on the government. The government will create an escrow-like facility and keep money aside for the repayment of the bond before the repayment is due. Other PSU bonds which have a government guarantee, the guarantee only kicks in when the issuer fails to make its repayment. Other sources have also told Bloomberg Quint that given the tranche size of this issue is so large, even banks could participate in addition to domestic and foreign investors. Further, the pricing of the bond might be higher than other previous public sector bond issues, and the pricing of the bond would be decided on the electronic bidding platform of the stock exchanges on the September 16th.
All right, now Somit Sarkar is here to tell you all about the stocks in news. Somit, good morning. What are the stocks at the center of the action today?
Well, good morning, Alex. Firstly, let's start off with Mahindra & Mahindra because they have observed a no production day for 8 to 17 days for both its automotive sector and the farm equipment sector. Similarly, SML Isuzu will also remain in focus because they have closed down their chassis manufacturing plant from September 16th to September 21st. Equitas Holding will remain in focus because SEBI has returned the draft scheme of arrangement that the company had filed earlier for the reverse listing of its small finance bank, and the SEBI has advised the company to resubmit the same after ensuring compliance with the norms. And the company in its response has stated that they will initiate necessary steps to list through an IPO, and they won't be going ahead with this reverse listing proposal that was earlier submitted to SEBI. Indiabulls Housing Finance will also remain in focus because the Delhi High Court has passed an injunction order against the Rajya Sabha member Subramaniam Swamy and others, and the order has currently barred Subramaniam Swamy and others from posting anything against the company. Now, Colgate's new managing director, this Ram Raghavan, had held an analyst meet, and it's an analyst meet. It said that the company's focus will be back on gaining market share as the key, and this will remain the key task for the company for the next few years. And it also said that the much wider play for the company would remain on natural products and premiumization, and it also aims at being more consumer focused rather than merely responding to competition. Bharat Electronics will also remain in focus because the company has won a large order of nearly 5,357 crore rupees for Akash missile systems from the Indian Air Force. And lastly, Reliance Home Finance will remain in focus because CARE Ratings has downgraded their credit rating to default rating for the long-term debt program of the company, and this is due to delay in servicing its debt amount of the non-convertible debentures that the company has.
Thanks so much for that, Somit. But there are several stories that are available on the website bloombergquint.com, not least of which what we've already spoken about. Let me also take you through some of the other stories that are currently available. Air India has posted an operational loss of about 4,600 crore rupees in the last financial year, mainly due to higher oil prices and foreign exchange losses. The net loss for the year stood at about 8,400 crore rupees. And State Bank of India will seek clarification from the Reserve Bank of India on whether it can offer long-term home loans with rates that will be initially fixed and then become floating, according to Chairman Rajneesh Kumar. This comes after the RBI mandated that lenders shift retail lending to floating rates that will be determined by external benchmarks like the repo rate. That's all you need to know going into trade today, but there's a lot more coming up in just a short while, and there's also a lot, like I mentioned, on the website bloombergquint.com. Do stay tuned. This is Bloomberg Quint.